Hello everyone. Welcome to another video on our channel, where we break down the historical behavior of markets and analyze key trends that impact our investment decisions. Today, we'll explore a dynamic chart showcasing the performance of the S&P 500 index measured by its price-to-sales ratio from 1995, comparing it to the price-to-sales ratio of the Magnificent Seven from 2016 to 2025. This chart is generated from the image displayed on the screen and will help us identify key market patterns. Tech companies have been the protagonists in recent years, and today in 2025, they are trading at an all-time high based on their price-to-earnings ratio. But do these valuations make sense? What does their comparison to the rest of the market reveal? Stay until the end to learn more about this topic and discover the weight of the top 5 S&P 500 stocks in the index, a topic we'll explore in another video. Let's start with the S&P 500. Since 1995, this index has reflected the evolution of the largest U.S. companies and, in many ways, the global market. The price-to-sales ratio is a crucial metric to understand how the market values company revenues. Over these 3 decades, we've observed significant fluctuations in this indicator. 1990s. During the dot-com boom, the S&P 500's price-to-sales ratio skyrocketed, reaching historic highs before collapsing in 2000. 2008. The global financial crisis dragged this ratio down, reflecting extreme market pessimism about revenue prospects. 2020. Amid the COVID-19 pandemic, the market experienced a record recovery fueled by fiscal and monetary stimulus. Today, in 2025, the price-to-sales ratio of the S&P 500 is once again at elevated levels, driven primarily by the dominance of tech companies. Now let's talk about the Magnificent Seven, the companies that have led technological transformation and dominated financial markets. These are Apple, the leader in consumer technology, known for its integrated ecosystem of devices and services. Microsoft, the software giant excelling in enterprise solutions and cloud computing. Amazon, a leader in e-commerce and cloud services. NVIDIA, a pioneer in artificial intelligence and graphics processing. Tesla, a leader in electric mobility and renewable energy. Meta, formerly Facebook, focused on social networks and the development of the metaverse. Alphabet, Google's parent company, dominating internet search and digital services. Since 2016, these companies have achieved extraordinary growth but have also raised their valuations to levels that spark debates on Wall Street today. Over the analyzed period, the price-to-sales ratio of the Magnificent Seven has shown a clear upward trend. 2016 to 2019. Valuations grew moderately, reflecting these companies' leadership in their sectors. 2020 to 2021. The pandemic accelerated digital transformation, pushing the price-to-sales ratio to unprecedented levels. 2025. Today, these companies are trading at an all-time high in their price-to-sales ratios, with some metrics far exceeding those of the broader market. For example, NVIDIA. Its focus on artificial intelligence has pushed its price-to-sales ratio above 40x. Tesla maintains a high multiple due to its position in clean energy, despite competitive challenges. The price-to-sales ratio is a helpful indicator, but it also has limitations. Extremely high levels may indicate unrealistic growth expectations. Let's examine some risks. Rising competition. Emerging companies could challenge the Magnificent Seven in innovation. Regulation. Increased scrutiny over monopolies and privacy could limit their growth. Interest rates. A higher interest rate environment could reduce valuations based on future growth. It's also important to remember that such high price-to-sales levels don't always translate into positive financial results. Market history shows that bubbles tend to form when investors chase disproportionate valuations without evaluating real fundamentals. While the Magnificent Seven are leaders, they're not the only options in the market. Consider exploring energy. companies transitioning to clean energy sources. Healthcare. Innovations in biotechnology and pharmaceuticals. Industrials. Benefiting from infrastructure booms. Diversification is always key to protecting your portfolio. Investing in less popular sectors could provide attractive returns with less volatility. To understand why the Magnificent Seven have reached these historical levels, we must also consider external factors influencing the market. Monetary policies. Since 2020, low interest rates have boosted tech valuations, but changes in central bank policies could negatively impact them. Accelerated digital transformation. The pandemic solidified tech companies as indispensable players in the global economy. Uneven global growth. While tech companies have thrived, other sectors have faced significant challenges. Although the Magnificent Seven lead, there are companies in other sectors that have demonstrated impressive performance without relying on exorbitant price-to-sales ratios. For example, Caterpillar, CAT, benefiting from infrastructure growth. Eli Lilly, LLY, innovating in pharmaceutical treatments. Chevron, CVX, adapting to the energy transition. These companies show that opportunities exist in the market beyond tech giants. For those looking to invest, it's essential to diversify. Don't place all your resources in one sector. Research. Assess the sustainability of current valuations. Be patient. Long-term investments tend to be less risky than speculative bets. Maintaining a disciplined approach and not being swayed by momentary trends is also crucial. Long-term decisions based on fundamentals are often the most successful. In summary, the price-to-sales ratio is a powerful tool for understanding how the market values companies. Today, in 2025, tech companies are at a historical high, but this also comes with risks. If you want to dive deeper into the topic, don't miss our next video, where we'll analyze the weight of the top 5 S&P 500 stocks in the index. Click on the video appearing on the screen to keep learning. Thank you for joining us. Don't forget to subscribe, like, and activate the notification bell for more content like this. See you in the next video. Finally, always evaluate global trends and how they might impact your portfolio. Financial education and continuous analysis are your best allies for making informed decisions. See you next time.